My name is Kabir Kubar. I'm with Flourish Ventures. We are an evergreen fund. We back entrepreneurs whose innovations help people achieve financial health and prosperity and help build a fair financial world. I am thrilled to bring to you today an exciting and important panel on the future of the digital infrastructure for finance in the United States. By all measures, the United States government responded sizably and swiftly to the pandemic, approving a pretty sizable package, three times the response to the 2008 financial crisis. I think the last numbers I've looked at, 12% of 2019 GDP, more than Germany, more than other countries. While Congress moved swiftly and the response was sizable, what followed exposed weaknesses of the retail financial system, especially key infrastructure components around payments, identity, data. For example, in July, after many countries had already dispersed stimulus payments to the most vulnerable population almost in minutes, millions in the United States had still not received their money, which was being distributed through prepaid cards. In the absence of a national identity system, some payments were sent to deceased people, fraudsters exploited unemployment programs. As we look ahead, there's going to be another set of stimulus measures. We need them. There's a new administration and a new threshold movement. We can learn from the lessons of the pandemic and build a better future. My panelists, who are experts in different aspects of the infrastructure components, passionate believers in the future, and I will talk through the lessons we learned and what we can do to address it. We will start with a short presentation from Olivia White, partner in the McKinsey San Francisco office, on a unique study that compared the effectiveness of 11 pandemic response programs across the world, including Singapore and the United States, looking at key infrastructure components, payments, identity, data, and how those components made it possible for those programs to be effective or not. Over to you, Olivia.
Thank you, Kabir, and welcome everyone. It's a real pleasure to be here. So as Kabir said, I'm going to talk through this piece of work on COVID-19, the value of digital ID and of financial data sharing, all against the backdrop of what matters around digital financial inclusion. So first is a bit of a preview of what I'm going to talk about more broadly. As Kabir said, the pandemic really stress tested financial infrastructure in the US and globally, and it made it critical to understand the gaps and the opportunities that countries face, just because the imperative of getting money to people was so high in many cases. And in this piece of work, we looked at 11 government economic disbursement programs across 6 countries. We looked at programs that covered SMEs and individuals both, and we asked, was the availability of financial infrastructure important and how to the effectiveness of the programs? And we found that 3 structural features needed to be in place for programs to be successful. The first was broad digital financial inclusion. So this means digital channels for fund disbursement, including the payment rails. The second, a presence of a basic digital ID system with broad population coverage that allowed authentication over digital channels. And third, simple data on individuals and businesses that was tethered to the ID that allowed appropriate disbursement. And the fact is that in places that had these features in place, disbursement programs were largely successful. And places that did not have these features in place needed to make trade-offs. And they needed to make trade-offs either in the ambition of their design, how large were the programs, how specific were the programs, how targeted were the programs, or in the success of their delivery, the actual execution. Were programs sufficiently fast? Was the coverage broad as intended? Was fraud limited or not? And there's a broad and more general point around all of this, which is that for resilience really to hold in these sorts of crisis situations, governments really do need to make sure that these elements of robust financial infrastructure are in place now, but also going forward. So now let me turn to some of the details of the work. So the 11 programs span 6 countries. So we looked at programs in India, in the US, in Brazil, in Nigeria, in Singapore, and in the UK. And we looked at programs of a couple different sorts. So we looked at 5 programs that targeted individuals directly, either relatively broad programs like the economic impact payment in the US, which went to everybody that had an income less than $75,000, or programs that were more targeted to vulnerable populations, as one saw in India, for example, or in Nigeria. We looked at a few business-targeted disbursement programs, so direct disbursements to businesses, largely with the aim of providing the ability to pay workers' salaries. And then we looked at business-targeted loans, collateralized either entirely or in very large part by the government. And we asked, how effective were these programs? So, as a bit of a groundwork, for each of the programs, we first said, were the required financial infrastructural features in place? And as a bit of a graphical illustration, we looked at the answer to this question on a triangle. So first, look at the left-hand side of this page, where we characterize what was in place for the job support scheme in Singapore. And just a little context on the program, it was an example of a successful program, and we can maybe say a little bit more later, where effectively the court passed business ID system enabled the ability to identify and therefore pay businesses using simple business data, so things like tax information and payroll history. And we looked and we said, look, what were these three structural features in place? And we graphically showed that on a triangle. So you'll see on the bottom left of the triangle, we characterized the degree of financial inclusion, that is access to a digital account and digital payment rails of the recipients of the program, so businesses. Top of the triangle, we characterized whether there was a basic authenticating digital ID system in place, again for the recipients. And then on the bottom right of the triangle was their simple data tethered to that digital ID. And the purple outline signifies that in the case of this job support scheme in Singapore, all of those three features were in place. As a separate example, we considered, for example, the conditional cash transfer program in Nigeria. And this was a program that was built upon a partial social registry that was already existing, that covered only 12% of households living in extreme poverty. So it was by necessity, unfortunately, having to start with a sort of limited registry. And disbursement had to be done in cash because a lot of these people, many of these, or if not all of these people, weren't financially included. And that corresponded to these infrastructural systems or these infrastructural characteristics not being in place. So you'll see the right-hand triangle, level of digital financial inclusion, sort of structurally low, digital ID effectively not in place, and very little or limited data tethered to that ID, partially because of the partial registry that it was based upon. So two programs with rather different structural features. Now, this is all a bit of a wind-up to saying, as we looked across all of the 11 programs that we examined, we found that they fell into four categories. And here are those four categories with four example programs. So first, there were some programs that showed design, delivery, and success. The job support scheme was one. More in a moment. Second, in some cases, when not all of those structural features were in place, programs had to sacrifice delivery. The Paycheck protection program in the US is an example of such a program. Third, in other instances, design was sacrificed. And that was a case, for example, with the Guaranteed Emergency Credit Line in India. And then fourth, there were programs in which sacrifice or trade-offs needed to be made both in ambition and in the success of the delivery, which was the case in the CCT in Nigeria. So just as a quick zoom on the job support scheme in Singapore, as I outlined on the previous page, you'll see the first first column of triangles. The financial infrastructural systems or elements were in place, leading to the next two right-hand triangles, where we look at design ambition and delivery success, both of which were high. And the way you see that, first for design ambition, we've shown graphically what was the scope of the program, what was its scale, and what was its specificity. That is, was it able to be designed in a way that actually targeted and treated differential populations differentially? And the basic outcome for the JSS was quite high. And then we said, was the actual delivery successful? So were funds dispersed quickly? The speed high. Second, was fraud low? And third, was coverage, that is, the people who received the money as intended in the design. And again, in the case of the JSS, very high marks. As another example, let's look at the Paycheck Protection Program in the US. That was a case where financial infrastructure underpinning the program was, at least on a relative basis, relatively high, associated with the digital payment rails, in the sense that there was at least strong digital connection or the potential for it between banks and the disburser of funds, so the Small Business Administration. One can say a variety of things about the way that that system worked and its smoothness of operation, but it was in place. The design ambition, scope and scale broad, specificity a little less broad, but nevertheless with a particular set of businesses that were eligible, at least in sort of design and principle. So not terrible on the design ambition front. However, if one looks at the far right-hand side, delivery success, far more limited. So speed was sacrificed in many instances, fast in some, but not in very many. Fraud levels, as we've all read about quite a lot, very high, at least compared to what the ambition would have been. And coverage was not what one might have hoped, particularly with more vulnerable businesses. So precisely the businesses who one was perhaps most eager to be able to reach were the ones that were less able to get the funds, even though they were in principle eligible. Now, I won't talk through the other lines here, but the logic is similar, and you can see graphically the point of the trade-offs in the four categories. And one can look at this across all 11 programs. Now, this page is a little bit of an eye chart, but the important aspect of it is that one can see that there were some programs that really did achieve both design and delivery success, at least on a relative basis. But there were many for which delivery was sacrificed, design was sacrificed, or there were real limitations both on the design and the delivery front. And the sort of graphical triangle representation that I talked through on the previous pages bears out here as well. Now, everything here, everything I've said so far, is with respect to individual programs. And obviously, these individual programs mattered tremendously, both because of their scale, and Kabir talked about this a little bit earlier, but also because many of these were directed to really very vulnerable populations for whom getting money quickly and as intended really was quite essential. But the fact is, this also matters from a macroeconomic perspective. And though it's not on the page, let me just share a couple of numbers, and this is all forthcoming in research to be published shortly. Backdrop here. We as McKinsey Global Institute published work in 2019 that looked at the potential benefit enabled by digital ID, and found that across countries, the potential uplift for digital ID that was linked to appropriate but well-protected and good practices to protect data, digital ID could increase or boost GDP at the country level between 3 and 13%, depending on the country and factors like the starting position and the nature of the economy. That's the backdrop. We then said, does that number change in the presence of these sorts of government payments, unprecedented government payments that we saw during the COVID pandemic? And indeed, we found that potential value at stake associated with having good digital ID, data tethered to that ID, and then the digital payment rails could mean that the value at stake went up by a factor of up to 1.2. So, for example, in a country like Brazil, where the potential value at stake associated with all of these things in good times, we found to be upwards of 13% GDP. That number could boost to 16% of GDP in the presence of something like the payments that we needed to make during the COVID pandemic. So this matters on an individual program level. It also matters on a macroeconomic level. But how to go even beyond that and to think, what are countries' abilities to be resilient in the next crisis or in the next instance in which a country has a real desire to get money, to get loans to its population quickly or in a particular and targeted way? And this shows graphically how to think about, or a nice way of thinking about where different countries stand. So the hexagon illustrates the elements of digital financial infrastructure, both as respect individuals and respect businesses. And you'll see on the left-hand side of the slide a pictorial key for what you're seeing here. The top three vertices in each of these hexagons, from left to right, show the level of the population who has access to digital channels for payment disbursement, the sort of measure of digital financial inclusion. Then next, population with digital ID, and next, population with relevant data linked to that ID. And the top three vertices are for individuals, the bottom three for businesses. If you look at what this means for individual countries, first look at Singapore. So Singapore has a rectangle that's almost entirely filled in. Good levels of digital financial infrastructure, albeit with some gaps on the individual side associated with digital ID and data tethered to that ID. By contrast, look at a country like Nigeria, or in fact, even the United States, where you see that the general size of that rectangle is the hexagon is very small. They're then countries in a sort of intermediate position. So you'll see, for instance, India, with the digital financial infrastructure broadly for individuals is very strong, again, with some areas for improvement, and for businesses leaves some real room to be desired. Or the UK, where on the business front things are strong, but there's not that same infrastructure in place, at least on a sort of systematic basis for individuals. And what this means is, in a country where that rectangle or that hexagon is big, the degree of resilience or flexibility, ability to design programs with the intended aims, very high. And in some sense, the JSS in Singapore was an illustration of that. In countries where the rectangle, I keep saying rectangle, so where the hexagon is small, the flexibility is significantly lower, and that has real implications for forward-looking resiliency and forward-looking flexibility in how programs are designed. So just to close, I'd like very much to thank Kabir for his partnership in much of this research, which in some form will be forthcoming very soon. So with that, Kabir, back to you.
Thank you, Olivia. This is a pretty critical study because you not only highlight, what would make programs themselves effective, the components that would make them effective, but also the implications for GDP. The macroeconomic link, I think, is pretty significant there. The data on Brazil, I'm really looking forward to the study. You really set the stage for this conversation that we're going to have with the rest of the panel, and I'm looking forward to digging into that. Let me introduce the rest of the panel. So you've met Olivia White, who's partner at San Francisco office, McKinsey and Company, but has worked globally with international institutions and is a very close ally and partner of Flourish Ventures. In addition to Olivia, we have Aaron Klein, Policy Director for the Center for Regulation and Markets at Brookings. He's a fellow there. He was previously at the Treasury Department on economic policy, and before that, chief economist for the Senate Banking Committee involved in critical reforms following the 2008 financial crisis. Dan Murphy is with the Financial Health Network, leads the network's work on consumer data rights. Financial Health Network is a leading voice on this issue in the United States. He previously worked on the Democratic Senatorial Campaign Committee. And Sonal Shah, my fellow Mumbaiker, is a founding executive director for the Beck Center for Social Impact, and served as the national policy director for Mayor Pete Buttigieg's 2020 presidential run. So, hello panelists, and I'm looking forward to getting into these issues. Let's start with picking up from where Olivia set the stage in terms of what's not working, and let's get into that. And Aaron, I want to start with you. The pandemic, and as Olivia characterized, exposed these shortcomings. The U.S. programs were not short in ambition, but they fell short on delivery and delivery success, specifically around speed. And a lot of that rests on the payments infrastructure. But before we dig into that piece, help us understand how the payment infrastructure has been already failing Americans before this pandemic even showed up. What's been the shortcomings of this infrastructure? And in what ways has it created challenges, especially for the most vulnerable in this country?
Thank you, Kabir. Thank you for setting this up and for your leadership and thought leadership and setting the stage and really thinking about these issues years before COVID was on any of our minds or brains. And unfortunately, this global pandemic may be what it takes to bring clear and lay bare a system in the United States that has, by benign neglect, caused hundreds of billions of dollars of economic loss to those who can least afford it. While the rest of the world, Singapore decades ago, England in 2008, Mexico, Brazil, even the entire European Union had moved to instant payments, the Federal Reserve's automated clearinghouse remained stuck in 20th century technology, requiring days for payments to clear in the United States. The core problem in the US system, I think, is twofold. The first is the central bank is tasked with both being the regulator of the speed of payments of the financial system and the operator of its own system. And in theory, you could have a regulator put in higher regulatory goals than their operational system could do. In theory, Blockbuster could have required streaming well before Netflix operationalized it. But in practice, that's not what happened. And as a result of this, the Fed has allowed a very slow payment system to exist. The other portion is that doesn't really harm wealthy people, but it creates incredible problems for people who live paycheck to paycheck. Divide Americans between the 50% of people who always have money in their bank account and the 50% of people who live paycheck to paycheck and sometimes run out. The latter group has to deal with an overdraft phenomenon, a $35 fee every time they run a payment credit before a debit has entered into their system. This generates about $35 billion a year in profit for the banking industry, which over the course of the last 15 years is almost $500 billion in overdraft fees. This is so large that one prominent US bank CEO named his yacht Overdraft because that's where this money essentially goes. So the system has been designed to be slow in a way in which low-income people have Hobbesian choices of expensive overdraft fees, check cashers, or payday lenders, all of whom are booming industries in the United States. I found Olivia's analysis to really hit home because it's similar to a broader analysis I've conducted just in the United States, which kind of redefines your triangle in three different elements that are necessary for immediate payment for something like a pandemic. One, universal accounts, in which the US does very well. If you saw that final hexagon, we were almost at the edge. 95% of American households have a bank account. But it requires then information connecting the government to the bank account, which was deeply lacking in the United States. Less than half of the people for whom were due these $1,200 direct payments did the US Treasury Department have your bank account information. And the third is a payment system that can move money from A to B. Whereas Congress passed the $1,200 payments at the end of March, it was almost 3 weeks later until the Treasury Department even began sending the information, which went out on Good Friday of that holiday weekend, to which it didn't hit consumers' accounts until that Wednesday. So these three things are what's holding back the United States system. It's held back by a combination of benign neglect and huge income and profit generation that can occur for lower income individuals as a result of a delayed system.
Thank you, Aaron. In fact, I think we calculated that if the payment system was indeed instant, real time, we could arguably put back $10 billion into the accounts of the most vulnerable populations, because that's the money that's been spent on check cashers and payday lenders. That's the money that's behind the boats that bankers are buying. So that would come back into the accounts of some of the most vulnerable populations. Is that right?
Absolutely. If only 20% of bank overdrafts, payday loans, and check cashers, and let's keep in mind, 15 to 20% of Americans use a payday lender, check casher, or wire transmitter, but they also have a bank account. So if you go into a bank, 1 out of every 5 or 1 out of every 6 customers who use that bank also use one of these other services. Why? Why, if you have a bank account, are you going to a check casher? Well, if you got paid on Friday and your money isn't going to be available until Tuesday, you got to live over the weekend. Cash clears instantly. Checks take days. Electronic payment is not direct. Millions of Americans will get their payday late in November because we have a holiday called Thanksgiving that falls on a Thursday, and standard payroll operations hit send on a payroll Tuesday, so it shows up on a Friday in your account. When Thursday's a holiday, very unusual to have a Thursday holiday, it's going to bump it over to the following Friday, triggering billions in unexpected costs and fees and some pretty angry workers. And over these costs add up over the decade, right? We are now 13 years since the United Kingdom rolled out real-time payments, right? At $10 billion a year of loss, $130 billion has been lost and counted. This system is not getting any faster in the United States. Do not be fooled by promises of a new central bank clearing system to be built sometime mid-next decade as a solution to a problem that is hitting the first of every month.
Okay, we're going to come back to how do we address these challenges. You mentioned the UK, the US, fintech innovations in the US, some of the leading innovations in the world. We have tremendous fintech energy, tremendous startup innovation energy. We invest in some of these companies, of course, but they sit on top of very dated infrastructure, something that I think the rest of the world doesn't fully understand, both on the private side, but also on the public side. And the other element that was critical in the triangle that subsequently changed the dimension of the hexagon in the McKinsey study is the identity system. And you mentioned aspects of that, Aaron, which is the information that the government has, for instance, but also just the information we need to serve people in the country and a framework around that to be able to access that. So, we observe the failures in that, but help us understand why that's been a challenge, why that's not working, why that doesn't exist in the US compared to other countries.
Thank you for this. And Olivia, thank you for setting up this great conversation. Really, really appreciate it. I think the triangle certainly helped, and then understanding how it fit into the hexagon was fantastic. Just one comment on Aaron's piece is, while the public system isn't working effectively, the private system for settlements actually is working. And so just keeping in mind that there is a difference in the public and private, and we need to merge those two pieces. So this is the same for digital identity. The challenge in digital identity is we do not, as a government, have access to information about the residents and the citizens that need access to the services, whether it's your digital payments, whether it's unemployment insurance. We cannot, half of the reason we can't process this information is we can't verify whether the person's correct. And that in today's time seems like an outrageous idea that we can't verify whether they are the right person to receive their $1,200 stimulus payment or the unemployment insurance. And the backlog that exists state by state, which sometimes is 30 days, sometimes it's 60 days, sometimes it's 90 days, they have to be verified by person. And you don't use technology to actually verify who the people are and making sure they're getting their payment. So that the way I think it works in the US, and that's the challenge, is it's patchwork. Information is not shared between agencies and amongst agencies. It is patchwork. It is not shared between states, counties, and local officials and the federal government. So what we have is a patchwork system that is not unified and where we can't even find who the right person is. So getting an identity system, maybe you don't have one individual identity, but using data that exists that allows us to verify who that person is. If you can do it in person, you can do it by technology, and making sure that they can get their services in a timely manner and their payments in a timely manner is something that we should be able to do. And frankly, we should learn from other countries. They've done it. I mean, you see it in Olivia's diagram that other countries have figured this out. This is a place where the United States can learn and do something about it.
Thanks, Sonal. And we're going to get to, how do we apply those lessons and what we can do specifically. Dan, help us understand the other sort of leg of this analysis, which is around data. In Olivia's study, and the conversation right now has been really around government data on individuals. But for a system to exist, with an open data for finance system to exist, it's both public and private data. There's a lot of innovation happening in this country, but again, it's sitting on top of sort of a framework, a set of laws, an infrastructure that's dated. Tell us what's not been working, even before this pandemic showed up.
Thanks, Kabir, and thanks to Olivia as well for all the work that you've done on this. This really is a very helpful piece. Kabir, I think that's the exact right question, and I think Sonal tees it up perfectly in reminding us that there really is a difference between public and private infrastructure in the U.S. on all three of these legs, and perhaps no more than on data. So it's really quite paradoxical. I think, you have all these problems on the public data side that Sonal has talked about in terms of not being able to identify individuals or find them. But on the private data side, there's really kind of a proliferation of data and very few rules of the road by which it's governed. And so we have this strange situation, and really this is a reflection of Americans' attitudes about not only government, but also towards not only government, but also the private sector, where the government might not be able to find me and find my updated bank account information to send me a stimulus payment. But Google can right now find my precise location and use it to send me a targeted advertisement about a local restaurant. That's really quite a strange system, and something that, as others have said, we should look elsewhere to think about what are some ways that we can change that. Now, specific to financial data, there are perhaps some stronger consumer data rights and protections with respect to financial data than there are to data more broadly when we think about social media companies and the like. However, really, they're very old and outdated protections in a lot of cases, and the time is more than ripe for those to be updated. So, privacy, accuracy, and security protections, in addition to other important concepts, all of that needs to be worked on. Now, I think what you could argue is working well, and Kabir, you started to hint at this in the US, is that we do have a pretty robust system for data portability in the US, where consumers are able to permission their data to other companies within financial services. However, as you've said, that's really built on a pretty old infrastructure itself in the form of credential sharing and screen scraping. So I give my username and password to an entity who uses it to log in and screen scrape the data out of my bank account. That's not really a very updated system, and we know the companies who work on this are updating that. There's a big effort on that. But one thing that I think everyone is in agreement on is that we need some rules of the road to govern this system. So in the UK, we've seen an open banking infrastructure. In the EU, we've seen PSD2. And in the US, there is part of Dodd-Frank, Section 1033, which the CFPB has authority to do rulemaking on, and they're going to. But it's taking quite a long time. We've been waiting 10 years for this. And so I think what we really need are rules of the road. And, we have a really highly developed private sector right now, but the government rules need to follow and be modern in accordance with that.
Thanks, Dan. And I'll come back to you to help us understand all the pieces there that we need to address when we have the next part of the conversation. So we have an understanding of what's not working, building on this excellent work that Olivia and her team have done and the analysis done by our panelists. Let's talk about what do we do to fix it, both in general terms, but also recommendations we might have for the Biden-Harris administration, for the new administration. Olivia, I want to start with Singapore, lessons from Singapore. You mentioned, it showed up at the top of your analysis as the Singaporean programs, in fact, were able to achieve what they intended to do. Help us understand, give us a bit more detail on what worked in those programs. I know they did well on all three components, but give us a bit more detail on what worked out.
Yeah, sure thing. Just a little bit of detail on how the job support scheme worked in Singapore, I think, is instructive. And it really sort of brings home the points that Aaron and Dan and Sanal have been making. So the JSS was put in place to enhance SME resiliency. And the basics were that the government co-funded between 25 and 75% of the first roughly $4,500 of gross monthly wages that would be paid to each local employee. And it was bounded as a 10-month period. And all of this came through cash subsidies to the businesses. And effectively what happened was that all employers, all businesses that had made mandatory contributions for local employees, so for Singapore citizens and permanent residents, qualified for the payout. And the program was rolled out quickly and in a streamlined way where funds were transferred automatically, digital payment rolls and immediate, to eligible businesses. And the eligible amount for each business was calculated based on 2019 and 2020 payroll with no application process needed. So effectively, this was all made possible by the fact that there was a corporate digital identity system, or CorpPass, which provided unique ID for businesses, and that was linked to information on the SME's tax payment and employee wage. And all of that was stored with the Inland Revenue Authority of Singapore. So all of this linked to what's called My Tax Portal. So effectively what you had was then on top of this, you had disbursement that came through widely adopted payments platforms. So effectively what you had was digital rails, digital ID, in this case directed towards businesses or with respect to businesses, and then unified linked data that was relevant. And I think it's actually worth just emphasizing that the data that was used here wasn't complicated data, really quite basic data that a government already has, but unified in the sorts of ways that Sonal was talking about. And all of a sudden, what you get is the ability to do what you want to do in a differentiated way. So not every business getting the same thing, in a differentiated way, very quickly as the situation demanded.
So Olivia, Singapore was able to move money pretty much instantly, but move it at a time of great need and get it to people according to their need. And so for that to really happen, it was based on a whole system that exists. And in addition to the instant payments, and where privacy is being addressed, where systems are talking to each other. And to the extent that my understanding is SMEs didn't even need to necessarily, quote unquote, apply for assistance. There was an understanding of the need and a visibility to the need. I think that's pretty powerful. Aaron, you had started to lay out, what needs to happen to get to instant payments. I think you alluded to the role of the Fed, for instance. And Sonal also mentioned the other dimension here, which is how do we think about the link between the public system, the public role, and the private systems that are emerging. What needs to happen to get to that instant payment? How do we get this money into accounts instantly within seconds? Who gives a damn whether it's Friday, Saturday, Sunday, Monday, it's a holiday? How do we make that happen? Lay that out for us.
So it's really easy, Kabir. Under existing law, the Federal Reserve has the regulatory authority to require the first $5,000 of a payment be available immediately to any customer who's been at the institution for 6 months or longer. So, you can't just walk into a bank account and defraud a fake $1 million check. But these are the payments that we're really talking about. They could do that with one regulation tomorrow if they wanted to. But the Fed doesn't want to because its own system could not comply. Of course, if the Fed did it, as Sonal pointed out, there are private sector solutions that would allow this money to be transmitted immediately. I think more than 70% of bank accounts in the United States are linked to the real-time payment network created by the clearinghouse. Or, of course, banks could provide the funds and let the money settle a day or two later, which, is kind of the opposite of the way that they do now, which is provide the funds to consumers who overdraft with a $35 fee and then wait for the funds to settle. So the banks are already fronting plenty of money. So this could be done by regulation, day one. It can be done by legislation. There's legislation proposed by Senators Chris Van Hollen and Elizabeth Warren and companion legislation in the House. This legislation would simply change the law that allows multiple days of wait and make the money be available immediately. That law could be passed by Congress. It is, in my opinion, the biggest thing we can do to decrease income inequality in America without raising taxes or increasing government spending. Step two to this problem has to do with the 5% of Americans who don't have accounts, which that number rises to 14% among African Americans and 12% among Latinos. There's a huge racial component. The reason people don't have bank accounts are expensive in the United States. There's high monthly minimums. There are these hidden overdraft fees. When you ask people without accounts, why don't you have one? The number one answer is cost, right? This makes sense. So this is different, by the way, than a lot of the old canards that are out there that have to do with bank branching and hours and a lot of focus on what is called deserts in the U.S. about areas without a branch. This is cited by less than 5% of unbanked people, location or hours, as the main reason why they don't have account. More than 10 times as many talk about cost. Solution, make the accounts lower income, lower fees. There's a product called a safe account, which is a very low cost account. You get all the bells and whistles of a general account, the ability to move money electronically. You just lack a checkbook, which is going out of fashion anyways in the United States. These should be mandatory. Every bank should be required to offer this type of account. This is not some big government intervention. It's actually what's considered the best practices today by the American Banking Association, the largest trade group of banks in the U.S. But these need to be required and made mandatory. And so the final point, Kabir, if you solve speed of payment and you solve the accounts, right, then the last part you have is the identity. And this part's a little bit trickier to solve immediately. Dan makes very clear that Americans are very comfortable with the private amount of information being served, being shared. We get a little more concerned about the government. However, I would also challenge that people are relatively comfortable with the government having their information. The government just doesn't keep it and keep it in a coordinated and unified way. The Treasury Department has given out direct stimulus payments 3 times in the 21st century already. This pandemic is not the first time we've tried to give money to people. We just don't keep their information handy. And there is no good reason for that. In addition, you saw in this pandemic, we tried to recreate the wheel and create a new portal to upload your information. When somehow the private sector is able to figure out how to get money out of me when I want to buy something new online in about 12 seconds. So I think that a little bit more proactive thinking here, the solutions are about what's been lacking is the will and the drive of policymakers. Hopefully that'll change.
Sonal, let's pick up on the IDs point that Aaron made. Is it similar? Is it that technologically we've addressed it, but we need to look at from a legal regulatory perspective? Do you believe that there can be? I doubt there can be a universal ID system in the US like we have in other countries, but could we get to something close to that, leveraging what already exists?
Yeah, thanks, Kabir. And I love listening to Aaron because when you're done listening to him, you're like, yeah, why aren't we doing something like that? But I think that
it's very simple.
I know. I want him to be my professor. I needed him to be my professor when I was in college. So I think the points that Aaron makes are so important and so true, right? We don't actually need, if we don't want to, have a one ID per person, which would be frankly simple and easier to do. But if we wanted to, we could cross-reference a lot of data. So let's say, for example, Aaron talked about the IRS, right? IRS has data on our taxes. Could you cross-reference that with the data from unemployment insurance? Can you cross-reference that data from those that are getting SNAP benefits? Can you cross-reference that with, we should be able to do that. But the fixes that are needed in government are both technical fixes. They're not sexy. It's creating a website, not creating anything fancy. It's actually fixes about making sure that data can be shared. It's making sure that we look at things like the NIST had a proposal 800-63-3. It's a digital identity guidelines under the Obama administration, which was started, but were not completed. We can complete that. This is not that difficult to do. It does not require legislation. It requires revising those guidelines and making that happen. It is already, the government has a login.gov portal. Invite everybody to log in through login.gov and use that as the identity that people can use. There is data that we can use that currently exists within government that we can make happen. And what I hope we do is not spend a ton of time trying to come up with new solutions, new ideas, new ways of doing things. Here, there are real things that can be done. Fix the NIST guidelines, get login.gov to work and use that as a basis to get started, then get started on the regulatory agencies, asking them to review the laws, the regulations, and the policies that government agencies can use to start sharing data more effectively. And we can do this, including privacy. It does not have to be there's privacy here and there's data here. It's like every other country in the world is doing this. We can actually do this. We can figure out privacy. We're not idiots. We know how to do that. We can do privacy, but also make services available. And then the last piece I would say here sometimes is that we sort of pit these conversations against each other. It's a privacy conversation, or it's a services conversation, or it's a payments conversation. These are not pitted against each other. The answer and the question we should be asking is, how do we serve people better? And how do we make sure their privacy is protected? Every government in the world is thinking about the exact same things.
Overwhelmingly agree with you, Sonal. I think part of the challenge is we are, surrounded by false dichotomies, and sort of part of this is also, it is part of how we see technology and the power and importance of technology. That's another challenge that we face. Dan, we keep hearing about data. Everything, all roads lead to this question around data. We've been talking about, I think, data government has and what data government can leverage. And earlier you mentioned, on the private sector side, there's a lot of innovation, but there are regulatory sort of gaps that need to be addressed. Looking ahead, okay, and let's talk generally, but also tell us specifically what you might recommend for the new administration. What could be done to address those gaps?
Absolutely. And I think the point Sonal makes is absolutely right, that as we go about updating our financial infrastructure to ensure that we're able to connect with folks in times of crisis and at other times, we don't have to sacrifice privacy in order to do that. We can build a modern privacy, consumer data rights and protection system while we do that. And so I think that's really what's needed. I think what we need are public policies that create that system. For those interested in the financial services side of this, we, the Financial Health Network, along with Flourish, FinReg Lab, and led by Mitchell Sandler, put together a working paper on the legal and regulatory landscape pertaining to consumer financial data in the U.S. And really what this does is it points to a lot of the open questions that need answering as we go about updating this landscape. So for anybody interested in a really detailed look, I would refer you to that piece. But at a high level, there's a few things I think that both regulators and that legislators could do here. To start with regulatory action, I think, the FTC is already doing a rulemaking on information security for non-banks. They should finish that, because right now there's a big gap there where we're kind of not really watching as closely as we should be. The OCC, FDIC, CFPB, and the Fed should issue interagency guidance on third-party risk management. That's something that's not being done, but should be. But the biggest one, and I alluded to it before, is the CFPB's rulemaking on Dodd-Frank Section 1033. Now, as I said, this has been something that we've been waiting for 10 years. And as they do it, I'm really encouraged to see that it looks like they'll be doing so in a way that not only addresses some of the open questions around data portability and 1033, but also answers some interlocking questions around accuracy in FICRA, around liability in EFTA, and privacy in GLBA. These are some of the alphabet soup of financial regulations in the U.S. that are relevant here for those who are lucky to be uninitiated. But what's important here is that the CFPB is doing this, and this is really one of the very few areas where there's outstanding legal authority for the Bureau to come out and actually fix some of these open questions or answer some of these open questions without any kind of legislative action needed. And so I'm really encouraged to see that happen, and that needs to continue and complete its work. Now, more broadly than that, I think legislation will be needed to create the most modern consumer data rights and protections in the way that we've seen some of the rest of the world and even individual U.S. states begin to do. And so what's really needed is a national data protection law that holistically addresses these issues both in the financial sector and beyond. And so we can talk a little bit more about what the barriers are to that. But I think that at the end of the day is the thing that we need the most.
Thank you. Thank you so much, Dan. I really appreciate you laying that out. I think, one of the laws you mentioned is the Financial Modernization Act of 1999. I think that's the GLBA. By the way, if you want to read this report and you want to understand this alphabet soup, please do reach out to Dan. I think it's pretty critical frontier work that's happening. The Financial Modernization Act of 1999, before the iPhone. I think that pretty much sums up, the state of regulation around data and laws around data in the U.S. Aaron and Sonal.
And that's actually more modern. That's actually more modern than some of the others as well.
Exactly. You're absolutely right. Exactly.
So one great little anecdote is that law required a privacy notice to be sent physically in mail. And this is about a 10-page document that no American has ever actually read. It goes straight into the trash. And when Congress tried to modernize that to allow electronic posting, it was fought by the timber industry, who was making such profit off of the amount of paper that needed to be sent around. The timber industry blocked for many months, almost years, making this notification electronic because the 1999 Act required a paper copy.
If you have a bank account in the US, you will get that privacy notice. And for just sort of a pure lesson in legal obfuscation, I recommend reading those documents. It's amazing. You will not understand what's going on with your data. I think that's part of the challenge that we face. But as Dan pointed out, it is solvable. And I appreciate you, Dan, laying out the specifics that we can go after. Aaron and Sonal, specifically. Aaron, I think you've already mentioned it, but maybe remind us, what do you think the Biden-Harris team needs to focus on next year to address this instant payment gap? And Sonal, I'll come to you next with the same question.
So if the Biden-Harris team cannot convince the Fed to modernize their regulation, they should throw all of their support behind passing this important legislation to move the money faster. And if not, they should consider the more radical step. The Treasury Department doesn't have to use the Federal Reserve to send the money. That's a choice, right? Wouldn't that create a shockwave, right? Imagine if the government were still sending somebody to Blockbuster to pick up cassettes because they didn't want to go to their competitor and stream the information because that wasn't nice within the government agencies. Two, the FDIC and the OCC, as Dan points out, all these acronyms, the U.S. is a very bifurcated financial regulatory system, should require under new leadership these low account financial services to be mandatory and to be offered. There's a lot this administration can do with or without Congress. And presumably, by the way, there ought to be some good bipartisan ability. A slow payment system is not a partisan issue, right? At its core, it's about competence. And in point of fact, when you think about this, I did some work with the mayor of Miami, a Republican, one of the largest cities in America to have a Republican mayor. Says, my citizens don't want to wait 3 days for their check to clear. regardless of what their party is. There's no ideology behind this. So there's a lot of room if you want to handle the blocking and tackling, not the lofty pie in the sky, create a whole new system of accounts. That may be necessary. We may need a radical different solution that takes time, but there's some very simple solutions that can be done immediately. You just have to roll up your sleeves and get in the trenches.
Sonal, similarly, block and tackle on the identity front, what would you recommend?
Yeah, I think this is, I just want to build upon what Aaron has said. I think there are some things that will require legislation. There are some things that do not require legislation. So just immediately, the administration can look at the NIST standards and push to revise and finalize the SP 800-6333. It's the Digital Identity Guidelines. Again, started under the Obama administration, but never fully completed. We can get that done. And it provides technical requirements for federal agencies implementing digital ID systems, including proofing and authentication of users using government IT systems over open networks. Like, that's important, over open networks. And it's, this is something that can be done. The private sector is waiting for the government response to standards on remote onboarding. We can make this happen. And this is immediate, does not require legislation. It requires action, and it requires a decision that needs to be made. Second, and as mentioned earlier, there are opportunities to already use existing capabilities that exist. Login.gov is a federal data services hub, part of the General Services Administration. It's already being used by 17 agencies, allows state and local governments to use login.gov. There's nothing preventing it from happening, but this can be used, and this is possible. And this is just requiring and making the incentives for adoption of login.gov by federal, state, local agencies. This is an authentication system that exists. There's other work that needs to be done, but this is something that can be done. CMS, Centers for Medicare and Medicaid, already uses it. This is something that already identifies who people are and what they should be doing. So again, NIST standards, login.gov, these are two immediate steps the administration can take. But I want to go back to the point Aaron made, which is, if we were to approach this as how do we help people in need that need the immediate services, we would approach this not as Republican or Democrat. We would approach it as, how do we make sure that people who elect their government can actually get the services that they need, that they have been asking for? And this is what these two things can do. Let's not get into partisan fights on this, because this is something people need. This is what people want. And we can make it easier even without all of the extra money. There's more things we can be doing in the meantime that solve that problem. But if we're going to push more money out, we need to make sure we get these systems fixed.
Thank you so much, Sonal. And in fact, all of these recommendations are in a report that we put together in partnership with some of the folks you see on this panel. It's specific recommendations for digital infrastructure for building a fair financial world. It's available on the Flourish Ventures website. It's available on the Beck Center website. I'm really thankful to all the panelists. Thank you, Olivia, for setting the stage for your great study, frankly, and we are all excited for it to come out, but also for setting the stage for this conversation. Thank you, all of you, for your tremendously specific and well-founded insights. I believe that the pandemic has taught us important lessons. I think we have learned these lessons. I think these conversations are far more immediate, far more material, and I'm confident that we can act on those lessons at a bare minimum in the face of a new crisis, but hopefully as a basis of building a better future for infrastructure for finance in the United States. Thank you all.